to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust, the best way to exit highly appreciated assets tax deferred, so you create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Schwartz. In each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspirations, so together we can make complex tax solutions simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, Kingdom Luxury Realty Facebook channel, and I'm excited about our next guest. He has been a multifamily broker now for about 2 years, leveraging some awesome tax strategies in order to generate clients and referrals. And so we're going to learn all about that and what he's doing. So please welcome David Evans. David, how you doing, man?
Hey, thanks for having me, Pearson.
Yeah, awesome. Well, let's dive right into this. So tell us your story. How'd you get to where you are?
So yeah, how I got to where I am is, like a lot of people in Southern California, transplant here, originally from the Chicago area, where I was a residential broker and multifamily investor. Within the last year or so, I came to know about the DST and really intrigued by it. I think the traditional process for many multifamily investors in Los Angeles is just using a 1031 exchange. One of the obstacles with the 1031 exchange as a sole tax deferment vehicle is unfortunately, of course, the limited timeline ID a replacement property, and just the prices are aggressive. So I'm really excited about being able to share with clients, the DST is an alternative to that.
Awesome. So can I ask you this? I believe everyone has been given a set of gifts or superpowers. What are one or two gifts or superpowers that you have that have led you to be successful?
I believe listening. It's being able to listening to the wants and needs of clients, prospective clients, to be able to find a solution that meets their obstacle. I think it's really important. I think that when you're having conversations with prospects, being able to share with them, or just more importantly, being able to find out what they would like, the end goal, or real estate to be for them, whether they're looking to grow or simplify, and being able to make sure that you're aware of the strategy that will help them best accomplish that goal, instead of just giving them a one-size-fits-all solution.
Yeah, no, absolutely. That's awesome. So listening to what the client's needs are, wants are, pain points, and solving their problems and helping them to get through that with a variety of different solutions. So that's awesome. Let's talk about one of those solutions. So you're familiar with the Deferred Sales Trust. How do you think the Deferred Sales Trust stacks up against some of the other capital gains tax deferral options out there today?
Well, I believe so with the traditional strategy, which is, exchanging into another multifamily property or, triple net retail property. I believe that it fills a gap for those who can't identify a replacement property within the timeline needed to do so. So I believe that's where its true value is. And it's also versatile in the sense where you can, if it's something that you need to exchange out of or liquidate out of to go back and invest in properties, you have that option, versus, once you get into another property, depending on where the market conditions are, you may not be able to sell that property if it's not a good fit, or the other DST, the Delaware Statutory Trust, where essentially you're just kind of, sucked into it. And it's something, it's an illiquid tax strategy. So that's where I believe the Deferred Sales Trust, value is this versatility versus some of the, primary tax strategies a lot of investors lean on.
Yeah, no, definitely. It provides a lot of flexibility, diversification, cash flow, liquidity, and we can kind of go through all that. But before I do, I just want to ask one more thing. So what's the number one secret to becoming a multifamily broker expert?
Call. Lots of calls. I mean, here in LA, I'm not, here in LA, pickup rates are low. So it's just really making a lot of calls. Following up, consistency. I think that's really what it is. And I mean, and definitely, making sure you're researching the market, not just knowing what sales comps are, knowing what litigation may negatively affect owners. Here in LA, we got the SB 679, which is considered the mansion tax, which will add an additional tax to real estate transactions. And you have a lot of other limiting regulations that control the way real estate investors are able to manage their properties, particularly multifamily, with the eviction moratorium, which is ongoing in Los Angeles for almost 3 years. We're finally getting a sunset on it come December 31st. So it's really just being informed about any changes to litigation that affects the way owner operators in the LA are able to manage their properties.
Yeah, and that's a tricky. LA is a tough market, especially for multifamily. I mean, from what I've seen, cap rates are super compressed, right? You have some really tough like tenant landlord laws that are really favored towards the tenant. How are you navigating this landscaping, especially now that rates are rising and sometimes they're higher than some of the cap rates that you'd be getting on the property. So how are you navigating this current economic landscape?
Well, to be clear, it's challenging with smaller. It can be challenging with smaller assets for sure, because there's more limited opportunities to add value. On larger assets, we're still seeing a great deal of demand. And it just really depends on the sophistication of the owner operator. Traditionally, some of the more savvy operators do tenant buyouts, so they're able to create vacancy, because unfortunately, that's the primary area where you have opportunity to raise rents to market rate. So that's where some of the more sophisticated operators we're seeing are taking advantage of.
So they're doing a cash for keys to vacate the property, and then from there doing their value adds and raising rents to market value.
That's correct.
Okay. And you're saying that demand for the larger assets are still relatively high, but for the smaller ones, so where's that threshold? Where's that threshold of
Well, yeah. So in Los Angeles, larger assets, depending on the submarket, can be anywhere north of 10 units. And I think there is still strong for smaller assets as well. The issue is, there's more of a price concession traditionally for smaller assets, with rising interest rates. Being able to make a deal pencil before with a 4% interest rate versus having to accomplish that same underwriting requires a significant discount in price. Now the interest rates are approaching 6, or at 6 in the residential market. So it's just really, I think we're seeing more of a price discount, definitely on smaller assets. On the larger assets, not as much. Primarily in demand has really been high in the non-local rent control markets. So that would be South Los Angeles County, Orange County, anything that was in Los Angeles proper that was built post 1979. We're seeing a high demand there. The obstacle with the last one is that there's not that much inventory built post 1979 that actually hits the market. Traditionally, those are longer term hold assets here.
Gotcha. So, all right. So you've got these specific pockets in the LA area that you guys are kind of focusing on, and you're looking for certain assets that meet the criteria, and you're finding success doing that. So the riches are in the niches, really, is what it's coming down to.
Oh, yeah, definitely. Definitely.
So, David, froze up. Oh. Looks like you jumped on me there for a second.
I can't hear you. I couldn't hear you.
Can you hear me now?
Yeah, I hear you good now.
Okay, great. Hey, I don't know, froze up on me a little bit. Okay, so what has been your biggest frustration with the 1031 exchange? I think you touched on it a little bit, but When it
Well,
comes to the 1031 specifically, what's been your biggest frustration?
I mean, I think the biggest frustration is, the timeline ID, and more importantly for, our investor clients is the, timeline to identify a suitable replacement property. And unfortunately, it sometimes requires, investors to exchange into properties, whereas if they didn't have the timeline, a deadline ID, they may not buy that deal. I think that's a part of one of the challenges. It's just a limited timeline um, to ID it and close on a property.
Yeah, those timelines can really make you a motivated buyer, and that is not a great position you want to be in. So, with that being said, we mentioned a little bit about the DST, and how you kind of like, try and use it to generate, maybe some listings, maybe some more value. How are you currently using it to kind of step yourself up as opposed to other people out there? And how did you find out about it?
I had someone reach out to me. It wasn't Brett. It was a local firm here reach out to me regarding the DST sometime last year. And you know, how I kind of add value is just really using it something as an additional thing in my toolkit. If when we have having conversations with principal investors and they're exploring disposition, and one of the objections is being, what can I buy? Everything's too high. Then establishing where their line of motivation is, and if they're motivated to, just sell regardless, is being able to share with them the DST as an alternative strategy.
Yeah, absolutely. And it's a powerful strategy too. Have you started using it as a way to kind of leading with it at all? And to be like, hey, you're not really willing to sell, but what if I could solve your problem? Would you consider selling then?
Well, truth to be told, I've kind of found out that the best way to do it is identify motivation first, because here in California we have a lot of legacy owners. So being able to establish whether they have an indication, motivation to simplify or downsize, then I lead with the DST. I found that doing it up front doesn't allow me to establish where there's existing motivation, and it just ends up not being the best use of time, unfortunately, because oftentimes a lot, these people, investors here get called all the time. So being able to establish whether there is motivation to sell first is, and then following up with the DST, I think is kind of the best strategy to use. Um,
Interesting. Okay, so what does that prospecting process look like for you then? How does it go?
so yeah, so I mean, the short of it is introducing myself, introducing my company, leading with some level of credibility statement, and it's just establishing, how it can help them, accomplish their, investment goals in relation to whatever the property is, 123 Main Street. And most of the times they share with me, what their goals are, whether they're not selling right now, if they're looking to acquire more, if they would be open to, explore selling a property. Then, once we kind of figure that out, I ask what's the strategy? What are you looking to accomplish? Are you looking to exchange into something else? Are you looking to simplify just totally exit the market? If they say they're just looking to totally exit the market or cash out, and introducing the DST will kind of be the next step to definitely help them avoid the capital gains issue. And I've also found that traditionally the less invested a investor or benefit or owner is in the market, meaning they are tend to be the more amenable to it. So if someone's deeply invested in the market, then exchanging into another property is probably going to be the strategy they take on. But if it's a property that they inherit from family or something along those lines, they tend to be a little bit more receptive to hearing about the DST. So I think it also kind of depends on how grounded or how rooted they are in the apartment market, to which determines their motivation to take advantage of it.
Yeah, yeah, that definitely. And you bring up a really good point that I have not, kind of thought about it, is how long has someone been rooted in that market, and what do they know? Because, people who are just kind of like all of a sudden, some property fell in their lap, and they're like, hey, like I can sell this thing and I can save all this tax, like, sweet, assuming they didn't get a stepped up in basis, right? Like, there's that whole situation. But if they were given a property or something like that and they're not super invested, it makes a lot of sense that they would be more receptive to trying a different solution or whatever. Or someone who's much more into that particular market, probably has his pulse on it, probably knows where to find a good deal, right? Probably had his eye on a deal for a long time, looking for an excuse to go out and make an offer on it. So that's some interesting insights.
Yeah, and in addition to that, I think it's just kind of about mindset. If you've been a multifamily owner operator for, 20, 30, 40, in some cases here, 50 years, you have more of a tethering towards it or a tethering towards a tangible real estate asset. It may not be multifamily, it may be a triple net retail property. So traditionally, those investors are going to be a little bit more reticent towards going towards a DST. And unfortunately, also, I hate to say it, but the phraseology of the DST being so similar to the Delaware Statutory Trust can also create a challenge in itself, because plenty of people have heard about the Delaware Statutory Trust. They may have not heard about the Deferred Sales Trust. And so, but having those same qualifiers sometimes creates some confusion there as well, because in their mind, they already know about the Delaware Statutory Trust. And for them, many times, that's a hard no. So I think that's a part. Those are two of the challenges I see. If they're already invested in real estate and have been for a long time, they want to be in another real estate asset, maybe just a little bit more simplified from a management operation standpoint. And then also sometimes the phrase, the letter qualifiers being the same can also kind of give you the wrong, can give people a bad, I guess, understanding of, not the Delaware Statutory Trust, it's the other DST. Just being so navigating those two things have been, at times can be a challenge.
Yeah, you always have to qualify right away. Just so we're clear, it's not talking about a Delaware Statutory Trust. Like I'll drop that the second someone says like, oh, I've heard about a DST. I'm like, not a Delaware, and they're like, I'm like, totally different. They're like, oh, okay, so you gotta drop that one real quick and just shut that down, because people think they know what they're talking about sometimes and they don't. And it's just
it's the equivalent of working at a commercial arm for a residential shop. I don't know how else to explain it. So, I've worked at commercial arms for residential shops before in the past. And the first time when they hear the name, they don't even necessarily hear, oh, it's the commercial arm of the shop. They say, oh, I sold, I don't, I'm not selling my house or something like that. It's kind of like that same thing. Unfortunately, sometimes letters can give people, a false positive versus what they, think they're getting into as far as a conversation.
Yeah. Interesting insights. Okay. We're coming up on our time here. I'm going to get you into the lightning round. But before I do, where can people find you, connect with you?
Yeah, so they can find me on LinkedIn, _ DEvans723. They can find me on Twitter, DavidEvans9 on Twitter. They can find me on Instagram. My first DEvans at CRE on Instagram. Sorry, there are 3 different tags, but I'm on LinkedIn, I'm on Instagram, I'm on Twitter. All my business accounts are there. Awesome. They can find me they can call me on my cell, which I can put in the chat. Yeah, and I'm always happy to answer questions regarding the market, what we're seeing, what opportunities we're bringing to market, yeah, it's happy to be a resource and the ever-changing landscape of commercial real estate in Los Angeles.
Gotcha.
Yeah.
Okay. There it is. Awesome. You ready to go in the lightning round?
Yeah, let's bring it.
All right. Here we go. All right, David, what's your favorite book?
Favorite book right now is Atomic Habits. Just got finished reading the second time.
Good book. Yep. What's your favorite leadership quote?
Favorite leadership quote? Ooh, that's a damn. What leaders are not born, they're made. I can't remember who said it.
Okay. What are you most curious about right now?
What am I most curious about right now? Really, I'm more curious about the debt markets because it's affecting us all. So being, it's just understanding how they operate. That's really what I'm most curious about right now.
Interesting. Awesome. Well, David, thank you so much for coming on. Do you have any parting words?
Yeah, I think there are opportunities in any given market. So I don't think if you're someone who's, investing in real estate, no matter if you're simplifying or you're looking to grow, there's still opportunities. So I don't think that you should allow interest rates to scare you. You just sharpen your pencil on the underwriting and proceed, from that point.
Yeah, wise advice. Awesome. Well, thank you so much for coming on. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, the best way to exit highly appreciated assets tax deferred so you create, preserve, and grow your wealth. Please rate, review, subscribe, like, comment, share, send it out for all the interwebs algorithms. And thank you guys again. We'll catch you on the next one. Have a good one.